Imagine waking up one morning only to realize that one decision that you made years ago has left you with far less financial security than you expected. And there's no do-overs or no second chances. That's the reality that many retirees face when choosing between a lump sum pension payout or a lifetime annuity. You see, it's not just about the numbers, it's about the risk, the longevity, and how that decision will impact your family's financial future. Today, I'm going to break down everything that you need to know when making this critical choice. By the end of this video, you're not only going to understand the pros and the cons of each option, but you'll also see a real-life example of how to fit this decision into your solid retirement plan. If we haven't met yet, I'm Jonathan Rankin, the founder and CEO of Theorem Wealth Management. We're the team behind the Think Retirement channel, and we've been helping people plan and execute their retirement goals across the country for going on 20 years now. See, every Monday and Friday, we release new videos that dive into key retirement concepts, but every single Wednesday, just like today, we're going to go through a real-life case study so that you can visualize your own retirement strategy. And if at any point in this video you find yourself wondering how much do you need for retirement, or if you're on track, then make sure you use the link in the description below because there's a quick quiz to help you see where you stand. Now, when it comes to making the critical decision between taking the lump sum pension and choosing the annuity payout, it's more than just a financial choice. It's a life-altering decision that could impact your financial security for decades. Now let's start with the basics. Let's start with the pension plan details. You see, this is where you lay the groundwork for your decision. See, most pensions offer two primary options, a lifetime annuity payout or a lump sum. Now, the annuity payout guarantees you a fixed income every month for the rest of your life. And it seems pretty simple, right? But it's critical to understand that there are different types of annuity options. You see, a single life annuity will pay you for as long as you live, but if you die early, then your heirs get absolutely nothing. And that sounds pretty risky. Now, if you're married or have someone that depends on you financially, then a joint and survivor annuity option might feel safer because not only will it pay you for the rest of your life, but if you prematurely pass, then it passes on to your beneficiary and it continues until they pass away. However, this option usually means that your monthly payment is going to be a lot lower. Now, the lump sum, that's a bit different. You see, you're essentially offered this present value of all the future payments from the annuity. Now, the key here is that the lump sum is discounted, meaning that it's worth less up front than you might think. Now, because the lump sum offers you control over the money, then you need to consider how it fits into your financial needs. And when it comes to your financial needs and long-term goals, this is where the stakes get even higher. See, if you're looking for guaranteed, predictable income in retirement, then the annuity is hard to beat because it provides you with that security and you're never going to have to worry about running out of money. That sounds great, right? But what if you have other goals for your retirement? What if you want to take a large trip or make a big purchase, or you want to help your kids with a down payment on a house? See, with the lump sum, you have flexibility to manage your own funds, which means that you can access those funds as needed. But with that flexibility comes that responsibility that you have to manage the funds and make smart investment choices and plan for taxes. Now, at this point, you might be leaning towards the flexibility of the lump sum pension, but before you do that, let's look at some real data. You see, according to the National Institute on Retirement Security, nearly 40% of retirees who take the lump sum deplete it in just 5 years. That's a terrifying statistic, and it highlights why this decision isn't just about what looks better on paper, it's about discipline and longevity. But before you make any decisions, think about this. What if your needs change or you're faced with unforeseen circumstances? That's where the security of an annuity comes into play. It guarantees income, but here's the problem. If you take the annuity, then you lose the flexibility. That's where the trade-off is. And then there's your health and longevity. Because what happens if your life expectancy doesn't match the assumptions of the pension plan? And this is the wild card that you absolutely need to consider, and this is where many people get caught off guard. You see, if you think you're in great health, then you might think the annuity option is a safe bet. You're setting yourself up for a steady income for the rest of your life. But what if something happens? What if you have a health issue or a shorter than average life expectancy? Then the annuity could potentially be a bad deal for you if you pass away too soon, because with most annuities, once you're gone, the payments stop. And that's money that you've lost. And see, here's the kicker. A lump sum gives you that full control of your money. So if you don't live as long as expected, then you can access the funds however you want. And if you live longer, you could decide to invest and grow that lump sum. But there's a catch, and there's always risk that you can outlive your lump sum if you don't manage it properly. At this point, you might feel like you have a solid understanding of what to do, but here's where the decision gets a lot more nuanced. Because with the lump sum, you need to consider the investment side of things. And that's where it can get a little tricky. You see, with the lump sum, you have the freedom to invest in whatever assets you believe will grow your wealth, whether that's stocks, bonds, or any other asset class. You name it. You might just think, I can grow my lump sum faster than the annuity payments would grow. And you're right. If you make the right investment choices, your money could outperform the annuity over time. But, and this is a very big but, what if the market crashes? Then your lump sum could shrink rapidly, and you could end up with less than you would have gotten from the annuity, and the security of the guaranteed income will really seem appealing, but it'll be too late. So while lump sum offers that potential growth, it also comes with market risk. On the other hand, the annuity offers you guaranteed income, but lacks the flexibility and growth potential. And then you have to think about how taxes come into play, because they'll affect both of these options. And this is where people get really tripped up. See, the tax implications of your choice will impact how much you really get from either option. If you take the lump sum, you could face a large tax bill in the year that you take it, since it's taxed at ordinary income. And this could push you into a higher tax bracket, reducing the amount you actually keep. Now, some plans allow you to roll that lump sum pension into an IRA, which means that every single distribution will be taxed at ordinary income. But here's the twist. You see, the annuity, it pays you out over time, so the taxes are spread out and you're not hit with a huge tax burden all at once. However, you still need to account for how that annuity income could increase your taxable income in the future. So if you think the lump sum is your way to go because of taxes, then consider you might be paying more in the short term, but the annuity spreads it out over time. But then there's also something else you need to think about, and that's inflation. See, inflation's been all the rage over the past couple of years, and it's something that we all worry about, especially in retirement. Over time, prices go up, as we know, and the money that you have today won't go as far in the future. And a fixed annuity could lose value because your monthly payments won't increase with inflation. So the money is not going to stretch as far as it did when you first retired. But with a lump sum, you can invest in assets that can potentially outpace inflation, whether that's stocks or inflation-protected bonds or any other asset class that does better than inflation. But, and this is important, if the market doesn't perform as expected, then you might find yourself struggling with inflation eating into your purchasing power, and your lump sum may not grow enough to keep up. And as we've seen over the past few years, one of the ways that the Fed attempts to control inflation is by raising interest rates, which is something that you should absolutely be paying attention to. Not because you're a fan of monetary policy, but because the interest rate environment is one of the most critical factors that influences whether you should take the lump sum or the annuity payout. And here's why. You see, interest rates affect how much money you're offered in a lump sum, as well as how much you'll get from the annuity. Understanding this dynamic is key to making an informed decision. You see, when you're offered a lump sum, it's essentially the present value of the annuity payments. In simple terms, the lump sum represents the amount of money that would be needed today invested in low-risk assets to provide you with the same amount of income that you would have received in the annuity over the course of your lifetime. And this is where interest rates come in. You see, when interest rates are low, then the present value of your future annuity payments is actually higher. Now, why, you might ask? Well, in a low interest rate environment, the money that you would receive from the annuity is discounted at a lower rate, meaning that the lump sum offered to you is greater because it's valued more highly today. It's like saying, if I give you this lump sum now, it's worth more because the returns on investment in the future are expected to be lower. In contrast, when interest rates are higher, then the opposite happens. The future value of those annuity payments are actually discounted at a higher rate, meaning the lump sum that you're offered is actually going to be lower. Now, why? It's because with higher interest rates, investors can actually earn more by investing the money in things like bonds or fixed income securities. This means that the future annuity payments are worth less in today's dollars, so the lump sum that will be offered will decrease. Let's break down with an example. So imagine that you're offered a lump sum of $500,000 to replace your future annuity. If interest rates are lower, then that $500,000 might be enough to give you a steady income for the rest of your life. But if interest rates rise, then the same amount of money might not give you the same level of income. In fact, the lump sum might drop to $450,000 because the future value of those payments has now been discounted more heavily. So if you're considering a lump sum and interest rates are low, it might be a good time to take the lump sum and invest it, as it could grow over time. On the other hand, if interest rates rise after you've taken the lump sum, then the annuity payout might become more attractive since it could offer better returns relative to what you could have earned investing that lump sum on your own. Now, when it comes to the annuity payout, interest rates also play a key role in how much you'll receive each month. So if you choose the annuity, then the insurance company or pension plan has to calculate your monthly payout based on how much it expects to earn on its investments. In a low rate environment, then the insurance company isn't able to earn as much from the money it invests, so it has to offer you a lower monthly payout to keep the plan solvent and meet its future obligations. Think of it like this. The company needs to make up for lower returns it's getting from its interest by offering you smaller monthly payouts. But if interest rates rise, then the insurance company can earn more on its investments, which allows it to offer you larger monthly payouts. And that's because it can rely on higher returns from bonds, treasuries, and other interest-based investments. In other words, the company has more of a cushion to pay out a higher benefit without risking its solvency. See, this isn't a short-term decision. The interest rates have a long-term impact on the performance of your retirement plan. See, if you take the lump sum, then you're essentially betting that you can manage and invest the money in a way that outpaces what the annuity could have provided. However, in a low interest rate environment, your investments might not provide the same returns that you would have received from the fixed annuity payouts. Alternatively, if you take the annuity in a low interest rate environment, then you may get a fixed, reliable income, but you're potentially locking yourself into a lower payout than what you could have gotten if rates were actually higher. And this might feel like a safe bet, but the opportunity to grow your wealth with a lump sum could be limited if interest rates stay low for a long period of time. Deciding between a lump sum and an annuity payout depends on a number of factors, but ultimately it's your unique situation, your goals, and financial strategy that should determine what you do. Incorporating the decision into your financial plan can help you see what your financial life looks like in each scenario. So let's look at a real-life example of the difference between a lump sum pension and annuity payout and some of the things that you should factor into your plan. So let's meet Ann and David. They recently came to us because they were wondering what they should do with their pension. So Ann's 63 and David is 64. Ann's currently retired and David is retiring at 65 when he's eligible to collect his pension. Now currently they're planning on taking Social Security at full retirement, and they'll have David's pension, which they projected at $51,000, and they were opting for the single life because it's that higher amount and they wanted a larger guaranteed income base. In savings, they've got about $2 million in 401ks, $350,000 in a joint account, and their expenses are $175,000 after tax. And they don't anticipate that changing because they like to do a lot of travel, and it's just a way to maintain their lifestyle. So let's take a look into their plan to see how they factored it into their retirement decision. So when we look at their plan, if they just kept it the way that they were anticipating, which is David retiring at 65, taking the single life pension, then they've got an 89% probability of success, and their assets last until age 90. And when we look at an average market, they should at that time have a little over $3 million left over. Now, that's just looking at things on the surface. That's not actually diving deep. And so what we want to do is dive deep and look at different scenarios. They were happy with these outcomes, but they were wondering, should they actually be considering the lump sum, because what they've been planning on is to take the annuity for David's life only. And what if something happened to David? And at that point, all the money goes away. So the first thing we want to look at is what happens if David passes away at 75. Now, if David passed away at 75, part of the conversation we had with Ann was that she would probably be spending less. So we also assumed that Ann's spending would go from $175,000 of after-tax income down to $140,000. So if that happened, then they would go from an 89% probability of success down to 86. As you could see, the pension ends when David passes away at 75. And by then, Ann would have her Social Security, and they would also have the portfolio assets to last the remainder of her life, which didn't give her the most comforting feeling. And this was just looking at if they were to take the single life annuity. Now, we also wanted to look at what happens if they actually took the joint pension. Now, the joint pension was a little less. The joint pension was only $42,000 per year, but what it did was it offered a much higher probability of success even if David passes away, because that amount continues for the course of Ann's life. So this made her feel a little bit more comfortable with the overall decision. Now, if they take this lower pension amount, what if David does live until he's 90? Well, if that's the case, then their probability of success actually goes down to 84% because they're still spending that $175,000 and they've locked themselves into that lower income amount of $42,000. But the main question they had was, should they actually consider the lump sum pension? You see, if they take the lump sum, their probability of success is 86%, which is lower than the 89% it would be if they just took the single life annuity on David's life. They also want to make sure that Ann was protected. So the thought of the single life annuity just wasn't on the table for them because it didn't give them the comfort they felt. So when they started going through this, they wanted to look at, if they took the $42,000 joint pension, well, their probability of success would be 84%, which is less than what it would be with the lump sum. But the caveat with the lump sum is that there's also that market risk. So we wanted to look at what does a bear market the year after David's retirement looks like. So this means that they got the lump sum pension, they rolled it into an IRA, and now they're taking distributions as they want. But what if the market goes down the year after he retires? And we're not talking about a massive 40 or 50% correction like we saw in 2008, 2009, or 2000 to 2002. We're going to look at what happens if the market just goes down by 20% in the year after he retires. So if that's the case, with the lump sum, he was at an 86% probability of success. If we go through that 1 year of bear market, just 1 year where the market's down 20%, it drops down to 44%. And they end up running out of money before they're 90 years old. So that's a major risk that they weren't anticipating, that they didn't think of. Now, if David were to pass away at 75 and they reduce their living expenses, well, then it gets even worse, because at that point, his Social Security also goes away. So as you could see, just taking the lump sum is not this default answer. You have to really think about, how are you going to invest those assets? How susceptible are they going to be to market risk? What does your lifestyle look like from an expense standpoint? Because if we just went through just that bear market, the most that they can spend to get back to a safe withdrawal rate would actually be $156,000, which means they'd have to take a $19,000 per year pay cut to make sure they can maintain their lifestyle. And one thing we also want to look at is, what if we go through that bear market and they're taking that joint pension? Well, if they're taking the joint pension at $42,000 a year, and we go through that bear market before they were at an 84% probability of success, if we go through that bear market, then they drop down to a 42% probability of success, and their assets still run out around 88 to 89 years old. But when we look at the most that they can spend to get back on track, it's actually $159,000 as opposed to $156,000 that we talked about with the lump sum. So they can spend a little bit more, essentially because they have that guaranteed floor of the income that's there. So it really comes down to control versus security. The lump sum gives you control and flexibility, that you can invest and withdraw it whenever you want, and you can leave it to your heirs as you see fit. But it comes with risk. The annuity, on the other hand, it provides a guaranteed income for life, but you lose that flexibility. And at the end of the day, this decision isn't easy, because it depends on your personal situation, your risk tolerance, and your financial goals. See, the right choice is going to be different for every single person. And it's about finding that balance between security and flexibility that works for you. See, just like Ann and David, it's important to assess all the different scenarios to make the best decision for your family, because there is no one-size-fits-all answer here. That's why it's crucial to do the active planning to make sure you're making the best decision for your family. Now, if you're struggling with this choice, then take our free retirement readiness quiz linked below, and we'll give you a clear picture of where you stand. And if you found this video helpful, don't forget to subscribe for more in-depth retirement planning insights every single week. Mondays and Fridays, new retirement concepts that come out. And every Wednesday, we're going to drop a case study just like this to help you visualize your retirement. Until next time, I'm Jonathan Rankin. Thank you for being here. I'll see you in the next one.